Hi, I'm Adam,
This is Kevin.
and we are Tech Guys Who Invest. This is the place for business people and investors to learn all about investing. We offer a fresh perspective on what it's like to have a day job while investing. And we share lessons learned on our investing journey. Our vision is to educate and entertain you while adding tons of value to your daily commute. Welcome to our show.
Welcome back to the Tech Guys Who Invest podcast, where it's our job each week to teach you how to invest wisely and safely. On this episode, we are talking about an asset class that gets talked about a lot for being a highly cash-flowing asset. So look at the room around you, wherever you're listening to the Tech Guys Who Invest podcast at the moment. I'm sure you have a ton of stuff that you're looking at thinking, when was the last time I used that? Or you put something up in your closet, and eventually you run out of space. So what do you do with those items where you're really not using? You could get rid of them and you could just donate them, whether they're clothes or some type of an electronic item. You can recycle them, you can sell them, or if you want to hang on to them and keep the space in your home, you can go ahead and put them in a self-storage. So that's what we're talking about today. We're going to pick the brain of Kris Benson, and he is the Chief Investment Officer at Reliant Investments. He quit his corporate day job, started investing in small residential, graduated to large multifamily properties, and now he uses that skill set to invest in self-storage units, which you see everywhere. And what you'll recognize and what you'll learn about is how powerful of an asset class self-storage units, self-storage properties can be to have in your portfolio. If you want to learn more about the investment project that the Tech Guys Who Invest have working in their pipeline, go ahead and reach out to us, techguyswhoinvest@gmail.com. If you want to be a guest on the show, please reach out to us as well. In fact, you can go to tgwipodcast.com/guest and book a time directly on our calendar to be a guest on the show. So without further ado, here is the episode with Kris Benson, where we talk about everything you need to know about self-storage units. Kris, thank you so much for your time today and agreeing to be a guest on the Tech Guys Who Invest podcast. We are delighted to have you on to talk about self-storage and all the value you're going to bring our listeners.
Well, I appreciate it. Hopefully I can live up to my end of the bargain.
Yeah, so Kris, let's start off with a question about self-storage units. We know you are in the business of investing in self-storage units, and we'd like to ask what are some advantages you see of investing in that versus other real estate asset classes?
Yeah, for sure. I think it's a great question. So I have, in my background, I've invested in residential real estate. I've also invested in multifamily. So have a little bit of background in those asset classes. Don't really know office and apartment very well or industrial. But when I made the transition to storage was really built on, I would say 3 pillars. And I'm a data guy, so I enjoy essentially historical data. I'm a big believer that, whatever's happened historically pretty much is going to be the best predictor of future results. So there's a data set that I can share with you. It's from the National Association of REITs. And essentially what it is they track all of the publicly traded REITs across all asset classes. And they have a pretty expansive data set, 25 years plus. And you can go and compare asset class by asset class, and at least at the REIT level, get a good apples to apples as far as what has done what over a pretty long period of time. So with storage, I would say there are 3 pillars, and I actually just did a presentation on this, so I'm pretty, I know this pitch pretty well. But there's 3 pillars really that I think make storage a really interesting asset class to invest in. And one is just total return, right? So if you look at this National Association of REIT data, they have a 25-year data set. So over the last 25 years, storage did just under 17% a year.
Wow.
Which is pretty incredible. If you compare that to some of the other asset classes, apartments did just under 13%. Office was, I think, in the 11s. All fantastic returns, but storage outperformed. I think what's more interesting is if you baseline that against the S&P 500, right, which, you guys have this podcast for a reason. The S&P during that same time period did just over 7%. So storage did really well. And then the next thing that I look at least when looking at an asset class is what happens in a downturn, what happens in a recession. Everything's cyclical, and there's a pretty good bet that it's going to happen again, right? There's no question about that. And I like to know how the asset class reacts. So from 2007, 8, and 9, that same data set, storage lost less than 4%. Apartments, it was close to 7. Office and retail got crushed, as you'd imagine. They were in the double-digit losses, and the S&P 500 was over 22%. So not only did it have really strong returns upside, but the downside protection was nice. And the hypothesis in the industry behind that is, in America, people don't get rid of things, right? So it's like
Absolutely.
Workforce housing, right? You catch people on the way up, right? So if you're that $900 a month apartment complex, as people are, on their way up from an income scale, you're catching people. And, when things turn down and people are downsizing, they may downsize, but they don't get rid of their things. And I can't tell you how many times I've been in a storage unit where, the stuff in the unit is worth less than a month's rent, but people continue to keep it. So wow. I think it's part of an American materialism issue. So those are the two pillars. And then the third pillar, for me at least, is what I think the long-term upside is on an asset class, right? As you guys know, it sounds like you've both done some multifamily investing. One of the big challenges with multifamily right now is there's a ton of money chasing deals, right? And institutional money has really made a huge play in the commercial multifamily asset class. And so in storage, there are 5 publicly traded REITs. And for your listeners who are driving down a highway right now, if they look on an exit ramp, there's a pretty good bet they're going to see an Extra Space or a Public Storage or a CubeSmart. And those are the public REITs that everybody knows about. There's 5 of those. And then there's a 6th company called U-Haul, which most people know as well. And they have a pretty substantial storage portfolio. So those 6 companies make up about 20 to 25%, depending on what data you look at, of the storage asset class. The rest is all over the board. So there's still a huge consolidation opportunity from the quote unquote mom and pop operators, people who have 1 or 2 facilities, for a regional operator like us. We're I think we actually just got pushed to the 25th, but we're a top 30 storage operator in the US, right? And we have as of today, 49 properties. So we're not that big. I mean, relatively we are, but, to give you some scale, Public Storage has over 2,200, right? Wow. So in between us and the number 1 storage operator, there's a big swath of people. So for me, really, that's the big kicker, is there's a big opportunity still to help consolidate the asset class. Sorry, that was a lot of talking.
Oh, that's awesome. That gives us all kinds of stuff to dive into.
Sure.
Yeah, there's a ton of stuff in there.
I see you guys furiously writing.
Gears are turning, trying to figure out how to ask or what to ask next. First of all, thank you for sharing that. I love that you started with the data, because Adam and I are from the school of thought where you do the math will tell you what to do. And you basically removed the emotion and said, look, here are the numbers. And you're not comparing fluffy numbers. You're comparing it against a long period, 25 years. So that is intense and awesome.
Yeah, I think, for all your listeners, no matter what phase of their investing career they're on, right, you just hit the nail right on the head. Emotion is the worst indicator. There's some gut, like my partner at Reliant is a big gut guy, and he's been right most of the time. And that's based off experience though. I mean, he's got 20 plus years in the storage industry. So, his gut is based off what he's done in the past. But, one of my mentors who's been a great, it's like having your dad, if your dad knew everything about real estate. He says the first look of the deal is usually the cleanest, because your emotion isn't involved yet. You don't like it yet. You're just looking at it and saying, numbers are saying this, yeah, maybe. And if it's a no, then, the deeper you get into your underwriting, the more you want to do it. Your bias is, hey, let's get this deal done. And I thought that was always good advice.
So you start basically convincing yourself that I could make this work, as opposed to it being clear cut that I have my threshold, it doesn't meet it, move on.
Yeah, absolutely. And Kevin, I know you're a salesperson now, and my background is sales. it's real easy to sell to salespeople. You hear a pitch, you're like, that's a good pitch. I'm going to buy that.
Oh, yeah. There's so many good questions that I would like to ask you. So one that popped out, though, Kris, when you were talking and giving us some of that was the timing of investing in this asset class right now. I know that's a big thing on everyone's mind. Feels like we're at the top of a cycle, corrections imminent. Well, is now a good time to invest in this asset class?
Well, I mean, I think it depends on what your goals are, right? We're in it for the long term. And I think there's some things you can do to protect against the next correction, right? What you're saying. I think you have to be really diligent, Kevin, to your point about the underwriting so that you're not overpaying. But, for us, our equity stack, or who comes up with the equity in all of our properties, is individual equity investors, right? So we're trying to protect their money, Kevin. And, the worst thing that can happen is we can lose the property to the bank, and then the bank, that's how an investor loses their principal, right? If you subscribe to Warren Buffett, rule number 1, never lose your money. And rule number 2 is see number 1. The goal is to make sure that you're in a position where even in a downturn, you have enough equity in a property. You're not too aggressive on your debt, so that if you have to go out and get additional debt on a property, you can without too much issue. So, I think, Kevin, you have to be careful. More the correction in storage isn't really the concern right now, just because of the last performance in the recession. I think the bigger concern in storage today is the supply side. So in 2017 and 2018, the storage industry delivered more new net rentable square footage than ever had been delivered in the past, in the history of the asset class. So in 2019, looks like it's going to be pretty close to the 2018 levels, and then 2020 is supposed to tail off. So, I'm not the only person who's looked at the storage data and said, wow, you can make some money in this. So, whenever that happens, you're going to get a glut of development, and we're in the midst of that cycle right now. So I think that's the bigger concern as we look at the biggest risks, and investors ask us all the time, like, what's the biggest risk? And that's it. It's supply side for sure.
Interesting.
Now, speaking of the risk and the way you make money with the storage, I know that you talked about it being more of a long-term play. And in multifamily, for example, you do value add where you can, as you know, do some sprucing up to then increase the rent. How does that work in terms of self-storage facilities?
We do the same thing. We put stainless steel appliances, granite countertops, and hardwood floors in our storage units.
Nice.
No. So our sweet spot, and Kevin, kind of back to your point about, or Adam, back to your point about the downturn, our sweet spot and strategy is really around value add. And if I could give you a perfect, right, if from a multifamily perspective, the perfect value add is C-class asset, A-class area. Rents are already, the premiums are exceptionally high, and you go in and do those rehabs and you're going to get those same rents. For us, it's, fantastic area with an asset that's cash flowing that we can expand into, right? And so most of our value add is built around, putting a shovel in the ground and doing some sort of expansion, maybe adding, climate control portion of the units. We've done 2 or 3 this year where the restructuring of the property was so that we can get more traffic count, right? So that basically the front of the property is on those super high traffic count roads versus kind of being tucked in the back. That's part of our strategy around value add and growing the net operating income, is typically that expansion. And what it does for us, right, is think about if you start with a 70% loan to value and you're doing a value add, a forced appreciation, and you can execute on it, by the time you're stabilized, now your loan to value may be in the 50s, right? Or for most of our pro formas, it works out to be somewhere in that mid 50s range. And so, that's a lot of protection in that next downturn, right? Where if we have to go out and get debt and we only owe 50% on the value of the property, even with a big correction, we're probably going to be okay, and that's how we look at it, sort of that downside protection. But yeah, Kevin, most of our value add is built around restructuring and what I would call, because our exit strategy is really built around selling to institutional investors or the REITs. It's kind of the institutionalizing of the property so that it is an attractive target for one of those buyers.
Okay, so that a question just popped in my head when you said that and mentioned about selling to REITs regarding branding. Do you brand your properties similarly, or provide some kind of a uniform look and feel to them so that you can package these up and make them more attractive to REITs, or is there any component of that in there?
Yeah, I mean, it's the branding in storage. There is no brand recognition, right? I mean, even with the big boys, like I'm not going to drive to go get to a CubeSmart, right? Storage is a convenience, right? In apartments, right? You want a school district or a specific amenity, so you're willing to drive for it.
Right.
In storage, we're offering a garage, right? So, although customer service is critically important and some of the amenities, gate access, safety, those kinds of things. But honestly, it's either close to your home or close to your work, or you're not going to use it, right?
Makes
70+% of our tenants come from a 5-mile radius, right? Yeah. So it's these little windows and pockets that matter. We do rebrand ours, Adam. We have 2 flags that we operate under: Midgard Self-Storage and StoreSmart. But it doesn't matter. Like for we change all our colors so they all look uniform, but it doesn't matter from the exit perspective. What the REITs or the institutions really want is a stabilized asset that they can implement their operational model on and get, a stabilized dividend for their stockholders. I mean, that's what they want.
Makes sense.
And then to unpack the whole REIT situation, if I understand correctly, you find let's say, private owner, mom, pop, however you want to phrase it, that you can see that there are some operational hiccups that are going on. You do some value add, maybe add some new security that you can then force appreciation, thus decreasing the loan to value. And then that becomes more attractive to REITs because they're not looking for necessarily home runs. They want consistent returns. Is that a fair understanding of what you were describing?
Yeah, I think so. And I think, the other piece is value add has a risk to it, right? Anytime you put a shovel in the ground, there's an execution risk, right? So that's why development deals are the most risky. You can go over budget, the market can change. So most REITs don't want that, right? They want a finished product that goes into a market that they can say, hey, I want to be in this market. Is there a product that we can go get instead of developing from the ground up? Because right now the replacement cost of an existing asset is cheaper than the development to, per square foot on a new asset. So that's really what we're doing. We're kind of like a middleman, right? Where we're trying to go into strong secondary and tertiary markets where we think there's going to be additional demand. And then, put ourselves in a position where if a REIT wants to come into that market, we're a really nice target to say, hey, we'll just go buy that and put a new sign on it versus go do our own ground up.
Yeah, so that's a good segue into location question I had. You mentioned secondary, tertiary markets, primary markets, and what do you look for in a location when you're considering?
Yeah, so not too dissimilar than any asset class, right? For us, things like population growth, job growth, income, they all matter. Traffic count is a big one for us. 30+% of our tenant base comes from drive-by, right? So, is it, like I had mentioned before, is it convenient to work or home? And typically if you're on a main thoroughfare, you're going to catch more people that it's convenient to work or home.
Right.
So, that's a big part of it. For us, the supply side is also critical, as I had mentioned, Adam. The big thing with storage, different than other asset classes, is it's a micro market game, right? So as I had mentioned, that 1, 3, and 5 mile ring around your property is really all that matters, right? So, in storage, we had talked about new supply coming on market. Well, there may be a market that's oversupplied, right? Let's just pick one, Denver, right? There's been a huge development in Denver, and there, as a whole, the MSA, Metropolitan Statistical Area, right? As that market is seeing some negative rent growth. But that doesn't mean that everywhere in Denver there's no opportunities, right? And that's kind of the part about storage is it's a sharpshooter's game. So there's always little pockets to go look for. And for us, that's kind of our job of our acquisitions team, right? Is to turn over every rock. Even if the market may be swamped, we may have a hole that we can fit into. So I think to your question, Adam, around what we look for, it's a really in-depth look at the specifics 1, 3, and 5, and the metrics that you already know, that everybody looks for: population, job, income, percentage of renters versus residential. Those are things that we look to try to help tell a story about the market. It's not one thing that's kind of the silver bullet. It's all of the data together to help us tell a story.
Interesting. I like that. This question just kind of came up when I was thinking about self-storage. I grew up in California, and a lot of people use their garage seemingly as a storage, but wherever you drive along a highway, you see a self-storage unit. Sure. And are there particular states that you see across the nation where they're more successful versus others?
Sure. The Northeast, for example, I just actually moved to Georgia, but I lived in New York basically my whole life. Everyone has basements, right? Mm-hmm. In the South, it's all slab, right? So Texas, Florida, the water table's so high, there's no basements. So just inherently, you have less storage space. Right. Not to say that there aren't storage facilities in the Northeast, but typically the demand for storage is higher in the Southeast than it is in the Northeast, at least nationally. Again, little pockets, sure, maybe more relevant, but at a high level, it's not like a market specific. But if you're looking at kind of those macroeconomic things, things that matter is we're a business of transition, right? So snowbirds, towns where they're transition in and out, right? Those people are putting their patio furniture in storage when they go home for the summer. It's things like that. People moving create, military base is a huge transition area, right? Where, people may be putting their stuff in storage as they're deployed, and it creates demand. So it's really a market by market specific. There's not really a blanket statement that says, hey, you should seek this. But certainly, not having basements helps.
Definitely.
So Kevin and I really like to educate our listeners. And by the way, thanks. I think you're doing a fantastic job of that. By the way, this is really, really interesting content. But we also like to have fun. And we would absolutely not be doing our listeners or ourselves justice if we didn't ask you some question about crazy things you've seen in a storage unit. You've got to have some stories, right?
I was thinking about that too.
So fortunately, like the arm of the business that I run is the equity side. So my part's clean, right? Like my job is just to go get the money and manage the investor arm. But our operations team, yeah. I mean, everything you've seen on TV at Storage Wars. Yeah. We've had people pass away in our storage facilities. People try to live in the units, which is obviously a big no-no.
Oh, wow.
But yeah, we've had a few of those situations. There was a facility, and I didn't see this personally. This is all anecdotal within the Reliant sort of archives, but there was one that we found a chair just in the middle of the storage unit with rope tied to the arms, and then like spatterings of blood all around it. What? You don't really want to know. I mean, we have security cameras that are everywhere in the facility, but once you're in the unit, you can do whatever you want, I guess. So, just like any business where you have thousands of people churning through it, you're going to get some weirdos that do some weird stuff. One more story. This one wasn't us, but it's a great one. So love it. I just read about it, so I can't take credit for it. But a guy, unfortunately, as he got older, suffered from dementia and was a fairly wealthy guy and put in his storage unit cash. And I'm exaggerating the numbers, but if your listeners Google this, I'm sure they can find the story. It was somewhere in the neighborhood of $700,000 to $1 million of cash
oh my God.
In his storage unit, and he stopped paying the bill. So they auctioned those, right? That's what Storage Wars is. And they auctioned it. Somebody bought it and got $1 million of cash in the unit. And, obviously, at least in the article that I read, and maybe it's been updated since, the family obviously made a big deal about that, as you can imagine. And we're trying to work out some negotiation where they could get that cash back. But, it's that kind of stuff where, people just put stuff in there and you never know what ultimately ends up there.
And talk about an ROI.
That's a good one. That would have been a good Storage Wars episode.
So who owns Is it the person who ends up buying that unit that ends up owning whatever's inside?
You got it. And each state's laws are a little bit different on the auctions. It's not, they're not fun for us. They're a huge pain in the butt. And we don't make any money off of them. We can only recoup basically, past rent due. But yeah, I mean, they're buying them, right? Because they're buying what's inside it.
Wow.
So is it exactly how it is on the show where they give you like 30 seconds to look around and then you give a price?
Yeah, most of it's done online now, right? It's online platforms where they can scale it, and the auctioneers get a percentage of the sales, and then our job, our incentive is just to get the unit turned so we can get somebody else in it to pay rent. For us, it's not a revenue site. It's not a revenue maker at all.
Right. Makes sense. Okay, Kris. So if someone, a lot of our listeners, in fact, probably most of our listeners work a day job, like a W-2, and they like their job, but they want to invest in real estate assets. If they were interested in investing in self-storage facilities, how might somebody with a day job do that?
Well, I think there's two paths you make a decision on, right? Do you want to be an active investor or a passive investor, right? And if you want to be an active investor, I would say storage, more so than other asset classes. It's a very active operational business. The leases are 30 days, right? So that can be really good and really bad. Like an apartment, you got somebody locked up for a year. So it's a very operationally intense business. And there's some technology that is helping kind of offset some of that. But I would say as an active investor, go partner with somebody, right? Find somebody who's an experienced operator that you can bring them some value. It could be money, it could be hustle, knowledge. There's really only three pillars to the deal. I'm stealing that from another guy, but it's money, hustle, or knowledge. It's one of those three.
Right.
And if you bring one of those to somebody else, or two out of the three, you're in pretty good shape. So if you have some cash and you got some hustle, but you don't know anything, you can find the person who has, the knowledge to help you. If you're looking for a passive opportunity, Adam, there's definitely opportunities. Most of our investors are high net worth accredited guys and gals who have day jobs, but they want that exposure to the asset class, and they want to partner with an experienced operator like us. And there's plenty of companies that do that. There's crowdfunding sites where your investors, I'm sure your listeners have seen the CrowdStreets, Realty Moguls of the world, where they can go on and have access. And they can obviously work with companies direct, and that's what we do most of the time.
Okay.
So those, like the crowdsourcing, or like you said, the U-Haul, those would be the people you would target, then, if I'm understanding correctly, after you've added your value to the property.
You're saying from a exit strategy standpoint?
Yeah, correct.
Not the crowdfunding so much.
Okay.
Usually operators go to those crowdfunding platforms to raise money to buy whatever it is they want to buy, right? So we would go, we have a relationship with two of the REITs. We would go to the REITs directly, and then if not, take it to a broker. And there's self-storage brokers, just like there are any asset class, who will bring that out to the marketplace.
I never would have thought that, but it makes sense now that you say it, a self-storage broker. But it never would have crossed my mind.
It's a big business.
Now, how would you recommend people who are interested in learning more about self-storage? What resources maybe that you leverage to get that pillar of the triangle, or that arm of the triangle, to learn more about self-storage units?
So I think there's a couple things. There's a company called Minico. It's an industry newsletter. They put out an annual almanac every year, a self-storage almanac, and I think they're 20 plus years into it. And that's really kind of the industry standard of what's happening. They do a really good job of their data collection. It costs money. I think it's $120. But if you have somebody who's serious about investing in storage, that's a great place to start. It's 150 pages plus of just industry knowledge, what's happening in the last 12 months. So I'd recommend that. That's a great one. On the other side of it is, find people who are experienced in storage and bring value to them so that they will share that value with you, And I think, my journey, at least into real estate, has all been predicated on willing to make a jump. So you have to educate, and then at some point you got to jump, because the best way to learn is be in it, right? And Absolutely. You're not going to learn any more than when you're in the middle of it making mistakes, and that's where the best learning opportunities exist.
Fantastic. Now, we are the Tech Guys Who Invest, and typically we like to ask our guests a piece of technology that's their favorite. But because I did some due diligence on you, if you will, I saw that your background was in medical devices. So I wanted to ask a little bit of a twist on this question. And what piece of medical device technology most fascinates you?
Well, I'm biased, right? Because I worked for the company for 9 years. So my background, I most recently worked, my last corporate job was with Intuitive Surgical, and they manufacture the Da Vinci robot. And many of your listeners probably know about that company more so because of the stock. It's been a generational. ISRG has been kind of like a Google or an Apple, in fact, outperformed depending on what time frame you look at. But what they're doing is essentially bringing computer-assisted surgery to the operating room. And that's branched off, Kevin, into multiple different specialties in surgery. We were doing it primarily in soft tissue. And basically the idea is you walk out of a surgery with 3 or 4 8-millimeter incisions as opposed to a big open incision, right? So you go home sooner, less chance of infection, length of stay is less. There's benefits to that, and there's an ROI to that at the hospital level as well. So, in the med device industry, I don't know how I could go anywhere else than Da Vinci, because honestly, I was very blessed to be a part of the company, and it was incredible, as was the technology.
Wow, that's amazing. That really is cool.
Yeah, you just Google it, watch some of the videos. It's incredible.
Yeah, there's a video of the machine, somebody performing surgery on a grape, which is one of the ones I saw when I was in college. So that's a really cool video.
Very cool.
There's another one of a guy painting with the Da Vinci, and he paints like this, I don't know, a landscape, and then they zoom out and they have it next to a dime, and then the landscape you can't see anymore because it's so small. Like just to demonstrate some of the accuracy and the ability to do, work on fine tissue. It is incredible.
Is that FDA approved use of the Da Vinci?
I think so. Painting, we sold a lot based on if you could paint with it. A lot of hospital executives wanted to invest.
Nice. So, Kris, if people would like to get a hold of you, what's the best way for them to do that?
Yeah, for sure. So if you're looking for more information on the platform on Reliant, go to ReliantInvestments.com. There's a bunch of information on our firm, our track record. That's more kind of on the investing side. We have a website called KrisBenson.com. So it's KrisBenson.com. And that one's really built around education. You can get to some investing stuff, but to be honest, what it was answering a lot of questions that we get from our investors. Video webinar series so that I could just say, hey, go here, watch these, and then call. And there's a lot of good stuff in there. It's free. You just have to put your email in and, you have access to it. So, and then I'm also pretty active on LinkedIn, where we do a lot of posting on LinkedIn and information on what we're up to. So we can certainly, you can search me on LinkedIn. I'd be happy to connect with you there as well.
Awesome. And we'll put all of that in the show notes for our listeners.
Great.
Well, Kris, thank you so much for your time and the awesome knowledge. I know that self-storage was something I read about in Rich Dad, Poor Dad. So it's great to finally talk to somebody within that niche. So thank you so much for your time and your knowledge.
Yeah, thanks a lot, Kris. This was awesome.
Yeah, no problem at all. Thanks for the opportunity, guys.
That's it for this episode of Tech Guys Who Invest. This is Adam.
And this is Kevin. Thank you so much for listening to us. Don't forget to join our Facebook page where we're building a community of investors so that we can share ideas, tips, and other ways to help us get out of the rat race. If you found value in this podcast, it would mean the world to us if you could share it with your network. Lastly, we love feedback. It's how we get better. So if you wouldn't mind spending 30 seconds and leaving us an honest review on iTunes or Stitcher or whatever platform you're using, that would be super sweet. If you want to get on Adam or Kevin's calendar, go to tgwipodcast.com/contact. We want to help you invest safely, wisely, and ultimately get you out of the rat race. Thanks again.